Good morning. This is Horizon's Middle East and Africa, our top stories this morning. Oil under pressure after reports OPEC Plus could be looking to raise output by as much as 137,000 barrels a day in November. U.S. President Donald Trump says a breakthrough could be coming soon to end the war in Gaza. Israeli Prime Minister Benjamin Netanyahu is set to meet Trump later today. And the United Nations will reimpose broad sanctions on Iran after diplomacy in New York failed to ease a standoff over Tehran's nuclear program. Well, it's just gone 8 a.m. across the Emirates. I'm Jumana Barsechi in Dubai. Once again, lots to grapple with geopolitically, some potential breakthroughs coming in the Middle East region, as has been touted by President Trump. So we're going to look ahead to that throughout the course of the show. And of course, markets in focus. Friday, we saw a bit of a positive reaction at Wall Street by the end of the week after PCE came in within expectations, slightly mild, which brought about continued buying towards the end of the day. Still for the week, though, the Wall Street indices tracked slightly more negative, but again, close to those all-time record highs. This week, S&P futures looking ahead slightly green. We have the jobs figures coming through on Friday will be a major determinant as well of where we go from here, with a lot of focus from all of those Fed policymakers on the state of the labor market in the U.S. So that's coming up on Friday. And don't forget, politically as well, within the U.S., we are getting closer and closer to the prospect of, once again, a U.S. government shutdown. So if there's no agreement in the Senate by midnight ET time tomorrow evening, then we could be looking at a government shutdown. We'll talk about what that could mean for markets. But this morning, we're seeing a bit of a pullback of the USD as we head into what could be quite a crucial week in terms of U.S. politics as well. Gold, another all-time record high. We're very close to $3,800 now, another 0.9% firmer. Money keeps pouring into that space. And then Brent just shy of $70. We actually saw a move upwards towards the close on Friday, especially around some of the commentary from NATO members suggesting that they would not hesitate to shoot down Russian aircraft if it enters into NATO airspace. So on the back of that, you saw oil move upwards. This morning, we're moving downwards on reports that OPEC Plus could consider bringing back extra barrels to the market at this upcoming meeting in a few days' time. So you've got a tale of two stories. You've basically got, on one hand, geopolitical premium, on the other hand, the prospects of extra supply hitting that market. Flipping over, and also I just want to point out that despite all of the headline risks that we speak of vis-a-vis the U.S. economy, geopolitical risk, political risk in the U.S., VIX keeps trending lower and lower and lower. So the VIX is essentially crashing, as you can see from these marks, down to around 15 points. At this point in time. And remember, earlier on in the year, we got as high as about 50 around the time of the tariff imposition on quote-unquote Liberation Day. We have come a long way since and continue to travel lower as these markets continue to make record highs. Okay, let's also check in on how markets in Asia are faring. Min Min Lo is in our Hong Kong studio. Min Min.
Hey, Jumana. Yes, Asian stocks largely, modestly in the green today, I would say. And it's led by the Hang Seng here in Hong Kong, up by 1.35%. And that's thanks to the big jump in industrial profits in China in August. We're talking about 20% on year, much better than expected. Year-to-date numbers was up 0.9%. And our Bloomberg economics team had forecasted a decline of 1.6%. So it suggests that perhaps that anti-involution campaign by the Chinese government is starting to bear fruit. So we're seeing the equity rally continue on in mainland China as well. The Nikkei doing not so well today. It seems like investors are a little bit jittery as we look ahead to that ruling LDP leadership vote on Saturday after Prime Minister Ishiba had resigned following the poor election results. Taiwan is closed today, so you don't see it on the board. But let's flip the board, take a look at some of the sectors we're watching. And Macau casinos, a sea of green, because we're looking ahead to the Golden Week holiday. It's going to be an 8-day holiday, longer than usual because it coincides with the Mid-Autumn Festival. And local reports show that Macau is expecting 150,000 daily visitors. That's compared to 140,000 last year. So we're seeing some of these stocks rise by about 5% or so. We're also checking rare earth stocks in China because the Chinese government announced that they are looking for breakthroughs in the materials sector, looking for more exploration as well as application of rare earths and minerals to support sectors like chips, AI, humanoid robotics, and the low-altitude sector. And here you can see also some of these mining stocks like Zijin Mining up by 3.4%.
Yep, heading into a long holiday week there, Min Min Lo in Hong Kong. Thank you so much. Well, the first jobs report after the Fed cut is the most anticipated indicator this week. U.S. jobs growth probably lumbered along in September as the unemployment rate held at an almost four-year high, extending a sluggish period for the labor market. We will also get factory data out of China this week and central bank decisions in Australia and India. So there's a lot going on. Joining us is Deepak Mehra, Commercial Bank of Dubai, Chief Economist. You know, earlier on when I started up the show, I was running through the price action in the VIX, and I mentioned that when we had Tariff Liberation Day, the VIX shot up to around 50 points, and now we're back to, close to 14 again, close to the lows of the year. At the time, there was peak concern globally in the U.S. about uncertainty, about what this was going to mean for the path of the economy, about what it was going to mean for inflation. And now we found out last week that in that same period, in the second quarter, the U.S. economy was growing north of 3%. Those fears were unjustified at the time. How are you feeling about the state of the U.S. economy, given how well actually the GDP numbers were for the last quarter?
Yeah, I think investors have got it all wrong. And we've worried too much about too many things, which didn't turn out.
Yeah.
And that is why this rally in equities has not been participated by many smart investors. And now you can see a FOMO setting in. Look, we had fears about tariffs leading to a recession, first of all. Then we said tariffs will lead to runaway inflation. Both didn't happen.
Yeah.
And in fact, we can see from the PCE report last week that the fear is more on the services inflation and not so much on the tariffs. It's still much lower.
Yeah,
on the goods, sorry.
So I did also, on that same print, personal spending numbers coming in higher than expectations speaks to the health of the U.S. consumer. So then raises the question, why should the U.S. be cutting interest rates then, if the backdrop for the U.S. economy is actually quite robust?
Yeah, that's exactly, I think, where the split is within the Fed right now.
Yeah.
And I think they're very concerned about the labor market because that's one of their core mandates. And when we saw the annual BLS benchmark revision, which shaved off 911,000 up to March, that was a massive one. So it's not just July and August numbers which are bad. It seems that labor market was bad even before tariffs kicked in. So that is a core mandate, and the Fed will have to respond to it. But how much will it respond is not very clear because inflation remains high. So
does it matter for these stock markets, though, if the Fed cut 5 more times or they cut 2 more times?
40% of S&P is tech, which is cash rich.
Yeah.
Actually, they benefit when the interest rates are high. They're least concerned with where the interest rates, and what does 25 or 50 or 75 basis points mean for a Google or Apple or Nvidia? Nothing.
Yeah.
And there are so many more now AI plays which are coming up. So it's not just the Mag 6, it's now much more.
We had a story this morning about the other ones that you need to be looking at, the Palantirs, the ones outside of Mag 7 that are really just charging ahead. At the beginning of the year, and I remember these conversations very clearly back in January, people were talking about U.S. outperforming the rest of the world. We had this U.S. exceptionalism theme that then got tested over the course of, let's say April to early summer. Do you think U.S. exceptionalism is back again now?
I think the sell America trade was completely, it was wrong trade. It wasn't warranted. U.S. exceptionalism has always been there, and it comes back. I think, if at all, what has happened in Europe and what's happened with the equity markets over there, I think it's a time to sell rather than buy. The diversification away from U.S. was not a good idea. U.S. has outperformed Europe. It has outperformed emerging markets since April.
Not if you had bought the USD. The dollar is still about 10% weaker this year. So what do you think happens with the dollar from here?
I think the U.S. dollar index has tested its very long-term averages twice, in July and then in September, hasn't breached it. Actually, it's bounced back both the times. So I think the worst for the U.S. dollar could be behind us. And you can see it, the flows into America and also the real interest rates that U.S. offers, the attractiveness of the U.S. treasuries. They've been one of the best performing government assets this year.
Are you not worried about valuations and the fact that stock valuations, PE valuations are looking lofty, the fact that credit spreads are close to all-time historical tights? Does this not raise a few alarm bells for you, though?
Well, the earnings have been so strong that the valuations are better than what they were when we entered this year. So it's getting better. And what do we compare it with? There are no comparables to these top U.S. companies. And it's not just the Mag 6. It's now maybe 15 or 20 stocks which are leading the rally.
Yeah.
Give me a comparative of that anywhere else in the world. Nowhere.
Yeah. Well, maybe China and more recently.
Yes.
Some of those China AI stocks. Deepak, well, I guess the takeaway from this is not that the U.S. is back, but the U.S. never went away.
Yes.
Deepak, thank you so much. Commercial Bank of Dubai Chief Economist joining us on Horizons. Well, President Trump is scheduled to meet with the top 4 congressional leaders on Monday. The bipartisan meeting comes a day before federal funding is set to expire, unless both sides can reach an agreement on a short-term spending bill.
Our view going into the meeting is that we want to find bipartisan common ground to find a spending agreement that avoids a government shutdown and actually meets the needs of the American people in terms of their health, their safety, and their economic well-being.
Democrats are insisting the bill must include an extension of health care subsidies and a restoration of budget cuts to health care, while Republicans say negotiations for those issues can happen after averting a shutdown. And still ahead, Iran says it will remain part of the Nuclear Proliferation Treaty, the NPT, despite renewed UN sanctions. We speak with Eyre, a former senior U.S. diplomat and distinguished diplomatic fellow at the Middle East Institute next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jemana Versace in Dubai. The U.S. and European powers are urging Iran to return to the negotiation table and comply with nuclear inspectors after UN sanctions snap back into place. Iran described the measures as illegal and baseless and warned of an appropriate and decisive response to any move aimed at harming the country's interests. Joining me now is Eyre, former senior U.S. diplomat and distinguished diplomatic fellow at the Middle East Institute. First of all, let me just start off by asking you, how significant is it, the fact that these sanctions have now been snapped back, or the snapback mechanism has been triggered?
Hello, Jemana. Thanks for having me on. I think it's more significant as of the overall trend of bilateral and multilateral relations with Iran. You know, it's the continuation of a process that started when President Trump pulled out of the JCPOA in 2018. The economic effect will be substantial on Iran. To an extent, that's already happened. It's an open question about to what extent these revived sanctions will be successfully implemented, since Russia, which is a member of the Security Council, has also said, as has Iran, that it doesn't see this reimposition of sanctions as legal by the E3, and they can put a significant spanner in the works in terms of successful UN implementation of these revived sanctions.
Question for you. Why is Iran not complying with the demands of the E3? Why are they dragging their feet here?
I think to a large extent, they feel that they were asked to give too much too early. One of the main problems with Iran is what it sees as signaling. Often the West, the U.S., and the E3 sees escalation. It has 400 kilograms, roughly, of highly enriched uranium, 60%. And the E3 and the U.S. wanted Iran to give this over as a precursor to negotiations. But in Iran's mind, this is, pardon my pun, a trump card, in the sense that this is something it's holding on to for the negotiations themselves. So part of the problem is that Iran has zero trust in the negotiating process with the U.S. and to a lesser extent with the E3. And part of it is that there's just a mismatch between what the West expects and what Iran is willing to give.
But a lot of this was also about giving the IAEA access to inspect some of those nuclear sites. I mean, the U.S. are calling for a full handover or at least identification of where they're hiding those enriched uranium facilities. But a lot of this is also about how much access the inspectors have. And do you think on that side of things, it was actually quite significant that in his UN General Assembly speech, the president said that they plan to remain in the non-proliferation treaty?
Well, that's a huge relief, because there had been some people who had said that Iran, in a fit of pique, might pull out of the NPT. But Iran is relatively rational in its calculations and realized that pulling out of the NPT would be a weapon in the hands of its enemies and would do far more harm than good. Iran is not willing to walk away from diplomacy. It will continue to reach out and try and engage with the IAEA in terms of access, though Iran often substitutes process for progress when it comes to cooperation with the IAEA. But no, I don't think they'll pull out of the NPT unless things get a lot worse. But they certainly will not cooperate fully with the IAEA to the extent necessary to reassure Western concerns about what Iran is doing with its nuclear program.
I thought it was also significant that in the Israeli Prime Minister Netanyahu's speech at the UN General Assembly, he also referenced Iran. And I've read a few comments out of analysts, some geopolitical think tanks out there who think that there could be a probability of yet another flaring up of the Iran-Israel front. What likelihood would you place on that?
Very likely. I mean, I think the U.S. has it in the mission accomplished file. If you listen to President Trump's speech, he cited the Iran-Israel war as one of the 7 wars he's ended. He says he's obliterated Iran's nuclear program. So I think to a large extent, while the U.S. sees this as a fait accompli, Israel still sees Iran, and not just its nuclear program, as an existential threat. As you said, Netanyahu in his speech talked about, in essence, regime change, a new Iran that could make peace with Israel. But amongst all these speeches that happened in the last week or so, the most important was a couple of days ago when it was by the Supreme Leader who said there's no benefit to negotiating with the U.S. In fact, it does real harm for Iran to negotiate with the U.S. And the most important thing, and this is the money quote, is that Iran needs to get stronger, i.e. it needs to restore strategic deterrence. That's what it's going to focus on.
Yeah, I mean, yeah, it's going to focus on that, but obviously the sanctions are going to have yet another potentially crippling impact on the economy. So remains to be seen. Alan Eyre, thank you so much for joining us on the show today, former senior U.S. diplomat and distinguished diplomatic fellow at the Middle East Institute. Thanks very much. Well, coming up, the Prime Minister Benjamin Netanyahu is set to meet with U.S. President Donald Trump as Israel's biggest ally intensifies a push for a ceasefire deal in Gaza. We are live from Jerusalem next. This is Bloomberg. Welcome back to Horizons Middle East and Africa. I'm Jumana Bersachi in Dubai. Israeli Prime Minister Benjamin Netanyahu is set to hold a meeting with U.S. President Donald Trump later today. This comes amid assertions that a plan to end the war in Gaza is nearly complete. Trump shared a proposal aimed at concluding the war with other regional heads in New York last week, with the U.S. president suggesting a potential deal could be soon.
It's looking like we have a deal on Gaza, and we'll let you know. Mr. President. I think it's a deal that will get the hostages back. It's going to be a deal that will end the war. It's going to be a deal it's going to be peace.
Let's go to Jerusalem now and speak to Bloomberg's Dan Williams. Well, there we just heard President Trump speaking to the press, saying that he's quite confident that there's going to be a ceasefire deal. He was posting about it all weekend as well. What has been the reception from the Israeli side, knowing that later today we know that the Israeli Prime Minister and President Trump will be having a one-on-one?
Well, the Israeli side has been unusually reticent, and I think therein lies a clue that this actually might work. The stage might indeed be set for some kind of breakthrough today. Now, the US president has made predictions of imminent breakthroughs, several, going back pretty much since the beginning of this term. However, now we have this war reaching its 2-year mark just a few days away. There is impatience, there is exhaustion, there is destruction and death all around. I think a desire to end things. And we also have a deep secrecy and compartmentalization within the Israeli government. It would appear that only 2 men, the Israeli Prime Minister Netanyahu and his top advisor, Strategic Affairs Minister Ron Dermer, are handling the talks. No one else in the government appears to know what's going on. And that kind of compartmentalization reminds me, at least, of the secrecy that preceded the landmark Abraham Accords 5 years ago, when Netanyahu excluded his own foreign minister and defense minister from those talks for the sake of secrecy, for the sake of seeing those talks through. So again, time will tell. We're a few hours away now. But given Trump's statement, given cautious statements now reaching Israeli media, it would appear there's a breakthrough in the works.
Yeah, okay. So that appears to be the case, and certainly the language that you're getting out of the U.S., there's pressure from the international community as well. But at the end of the day, the Prime Minister has to sell this back home. He has to sell it to his own government. And there are many within his own government calling for the annexation of the West Bank. And as we understand from, this draft 21-point proposal, that's off the table for the United States. How will the Israeli Prime Minister then pitch this deal back to some of the ministers in his own cabinet who would not perhaps like to see the war end right now?
Well, that's very well noted, and it would appear to support the idea that Netanyahu is compartmentalizing those ministers especially. But they've already come out and threatened effectively to bring down the government. However, their power is limited, and Netanyahu has had an offer from the Israeli opposition that should this deal go through, he would have support in parliament against no confidence motions and the like. So politically, he would survive, but we would see a cascade of walkouts of recrimination that would possibly trigger a new election in Israel, an early election. The election is currently scheduled for a year from now. We'd probably see it early next year. It's worth remembering that according to polls, a majority of Israelis, perhaps not a large majority, nonetheless a majority, want the war ended with a negotiated deal to return those hostages. The question is if the Netanyahu government's war aims, not only of returning those hostages, but ending Hamas rule, can also be achieved.
Bloomberg's Dan Williams in Jerusalem, thank you so much for setting out the scene for us for later today. Important meeting coming up. Well, coming up, sources say OPEC Plus is likely to raise oil output again in November. We'll discuss the outlook with Svelland Capital's Nadia Martin Wiggen. That's coming up next. This is Bloomberg. Good morning. This is Horizons Middle East and Africa, our top stories this morning. Oil under pressure after reports OPEC Plus could be looking to raise output by as much as 137,000 barrels a day in November. U.S. President Donald Trump says a breakthrough could be coming soon to end the war in Gaza. Israeli Prime Minister Benjamin Netanyahu is set to meet Trump later today. And the United Nations will reimpose broad sanctions on Iran after diplomacy in New York failed to ease a standoff over Tehran's nuclear program. It's just gone 8:30 a.m. across the Emirates. I'm Jumana Bersachi in Dubai. Well, we spent a good chunk of the first half of the show talking about some of the geopolitical risks in this part of the world, in addition to the real possibility of a U.S. shutdown as soon as tomorrow and what that could mean for markets. And obviously, we're gearing up for some important labor data coming through on Friday. The jobs data going to be closely watched by all market participants for more signs of labor weakness, especially after the Fed have restarted their cutting cycle. So it's going to be quite a big one on Friday. Wall Street by the end of the day last week closing up in the green. Today we've got S&P futures also leaning more positive, up 0.3%. The USD slipping, so back to doing what it has been doing for most of this year. So trading slightly weaker, still down more than 10% for the year. And again, the politics high on the agenda for anyone trading the USD this week. Gold also, take a look at gold, $3,800, yet another all-time high. really seeing an outsized move this morning, once again up 1%. So perhaps that is, again, on back of some of the geopolitical uncertainty that I was speaking about, and the fact that USD is coming off, interest rates, traders are pricing more and more interest rate cuts. All of that has been helping these safe havens. So gold very close to 3,800. All-time record high. And then Brent slipping this morning, down 0.6%. Though we did scale $70 on Friday, this in response to some comments that came through from some NATO members suggesting that they would not hesitate to shoot down Russian aircraft should they enter into NATO airspace. So really upping the ante a little bit there. But this morning coming down on reports that OPEC Plus could once again signal that they're putting extra barrels back to the market in November. So you've got the supply side and you've got geopolitics on the other. We'll talk about that in a moment with our guest. Switching over, speaking about all the volatility in the market, there is not a lot of volatility in stocks. The VIX keeps trending lower. We're sitting at around 15.3 now. Down about 35 percentage points since those highs that we reached back in April. Remember, we broke through 50 to the upside around all of the tariff announcements in April, quote-unquote, Liberation Day. And since then, it's been a steady decline lower and lower. So that's the picture for VIX. It's essentially crashing as geopolitical stress abates. And I wouldn't say it's actually abating. It's just the market interpretation of the impact some of these geopolitical risk premiums going to have on markets is abating. Okay, let's check in also on how markets in Asia are faring this morning. Min Min Lo is in our Hong Kong studio. Min Min.
Yes, Jumana, we are keeping an eye on Chinese markets today because you can look at the chart here which maps the industrial profits numbers. That's the white line over here. You can see a big uptick. Over the weekend, we got that surprise 20% jump in industrial profits, certainly surprising many economists to the upside. And we are also seeing the Shanghai Composite rising over the past months, which suggests that equity investors are already pricing in the improvement in the industrial profits here after we heard government rhetoric suggesting that the government is really placing a lot of emphasis on that anti-involution campaign. So we're keeping an eye on the valuation multiples here because we're now at about 15. It's still cheap compared to the S&P, and so potentially the equity rally still has legs to run. But it's also a tech story here in China today. Alibaba, big move up by about 4% after Morgan Stanley raised the price target there. There continues to be this optimism into China's AI spending. But flip the board, we're taking a look at what we're anticipating as we head towards the Golden Week holiday, an 8-day holiday, longer than usual because it coincides with Mid-Autumn Festival as well. And here you can see Trip.com up 2.5%. Some preliminary numbers from tour operators saying we're already seeing 130% increase in holiday bookings, and some of these Macau casino stocks up by 5% or so. Local media reporting that Macau is expecting 150,000 daily visitors, much higher than 140,000 that we saw last year during the Golden Week holiday. We're also checking some minerals stocks as well, rare earths, because the Chinese government has announced they're looking for breakthroughs in this sector, supporting more mineral exploration as well as application of this sector to support things like AI, robotics, the low altitude economy, and we see Zijin Mining here, the biggest mining stock in China, up by 3.4% today.
Min Min, thank you so much. Min Min Lo in Hong Kong. Let's turn to commodities now. Oil retreated after briefly spiking over the weekend on geopolitical risk. That's as sources say OPEC Plus is likely to raise oil output again in November, continuing its strategy to reclaim market share over maintaining price, even though prices haven't moved a lot in the last couple of months. Joining us is Nadia Martin Wiggen, Svelland Capital Director. Really good to have you with us in Dubai. It's great to have you in the region, Nadia.
Thank you.
You know, I look at Brent trading basically now around $70, and I wonder why we are here, despite the fact that OPEC Plus has been putting all this extra supply back to the market. Is it because we've seen surprise upside on the demand side, or is it because there's still a geopolitical risk premium embedded into oil at $70?
We would say at Svelland Capital, it's both. I mean, on the demand side, definitely versus IEA expectations, demand has been higher. We haven't seen inventory builds in the OECD. We didn't build in the first quarter. We only built 350,000 barrels per day in the second quarter, and yet to be seen what happens in the third quarter. I mean, we've probably built around 20 million barrels in September, but that's very, very low versus expectations. Yeah. And when all the analysts have been forecasting 1, 2, up to 4 million barrel per day builds in the fourth quarter. The market's much more skeptical because it's gone into strategic stockpiling in China.
Yes.
The geopolitical risk, we have OPEC agreeing to increase production, but really so far we've only seen Saudi Arabia at around 400,000 barrels per day of oil in the last 2 months. And then Emirates have been raising production, 100,000 barrels per day, month on month since June. Now, the rest of the group hasn't been increasing, and Russia has 600,000 barrels per day almost of refinery outages right now. And we've only seen about 250,000, 300,000 barrels per day of additional oil in the market right now.
Yeah.
That's before production increases. And so that's where the market is a little bit concerned. Can Russia actually sell as much oil as they should? And can the rest of the OPEC group increase production? Or is it only about the UAE and Saudi Arabia?
That's really interesting. What about news over the weekend that the Kurdistan pipeline is going to be reopened again? I'm seeing that it could add around 200,000 barrels a day of production. Does that move the needle at all?
Well, it does help, absolutely. And the big point is that Iraq has been overproducing throughout this cycle. And when you raise the level that they can produce at, then they're suddenly more compliant. So if and when we get an oversupply that really starts to hit the market, maybe Q1 of next year, then they're compliant, and then they should really cut. And that's where we view this. This isn't Saudi Arabia going for market share and trying to break shale. This is about getting everyone in line and having them understand that, look, we Saudi Arabia, we the UAE, we can add production and break this market if you want us to, if you threaten us, or we will be cutting and you will be cutting as well.
I mean, essentially for me, it just seems to come back to what happens with stockpiles, because that is where market analysts have been grossly overestimating the size of the inventory buildup. And to go back to what you were saying at the beginning, why has OECD stockpiles, why have they not gone up as much as we thought they would?
Well, number one, we're having less U.S. production growth, right? We think we've peaked for now in July, August. So we'll come down at least 100, 200,000 barrels per day from that into December. We have had OPEC saying they're increasing production, but they haven't increased that much. But number one is demand. And this is where demand has been viewed as low as maybe 800,000 barrels per day this year-on-year growth, the tariffs from Trump. But when we look at the physical market, the shipping market doesn't lie. VLCC rates are flying. So this is where we see there is that demand. And
do you think that China stockpiling is going to continue for the foreseeable future?
Well, that comes down to price. And they've been very happy in this range to build stockpiles because they're worried. What if OPEC loses control of the upside on the pricing because the spare capacity isn't 5 million barrels per day like the IEA says? We think it's more like 2.5 million barrels per day spare capacity, 3 million barrels per day. If we get down to 1.5 million barrels per day or 1 million barrels per day, that's when you lose control of the upside, and we can start looking at triple-digit oil again.
Okay, reading across everything you're saying, would you say $80 is more likely than 60? I'm pinning you down. I'm pinning you down.
Well, we're still in the 60s.
It's anti-consensus,
but it's like, I think a lot of forecasting is in the 50s. And when you look at algorithmic trading and positioning, that's why we've popped at 70, is that everyone had a sell recommendation. And then on Wednesday, we got a buy recommendation in the Brent market. We're not there yet in WTI. And that's where we have that short covering coming.
Yeah, I just feel like there's a lot of complacency, especially our prior guest was talking about the possibility even of, Iran-Israel flaring up again. And then you look at the fundamentals that you were just highlighting. And it does tell you that the market is positioned a certain way. But I want to move on to something else, Nadia. I know we've been talking about oil, but you also have been looking at the gold complex too. We're close to $3,800, another all-time record high. I feel the whole year this year we've been talking about gold making all-time record highs. When does this stop, and how does it stop?
Well, we at Svelland Capital don't really see it stopping unless we have a complete change in the world order. And right now, we're changing in a different direction. We've had BRICS coming closer together, and I would say we've had 25 all-time highs probably in the last 2.5 years. And the big driver has been the BRICS countries, and China in particular has been buying so much gold. But what we've seen in the last couple of quarters, Central and Eastern Europe are really building up their reserves by the central banks. And that's led by Poland, Czech Republic, Azerbaijan. Now, before Russia invaded Ukraine 2.0, they spent 2 years building up their gold reserves. That's why the ruble's been as stable as it has been. So we now see Central and Eastern Europe are very nervous. They're building up those reserves. But then we have China that only has 6.5% of their reserves in gold. And we constantly have treasuries coming due, and then they can buy gold. And they announced last week that they want to be a reserve area, right?
Yeah.
And if you look at London, there's $600 billion sitting there in physical gold. China only has $200 billion right now. And they need to build that up. And when we think about an export economy like Germany, they have more than 77% of their reserves sitting in physical gold.
Yeah.
You know, and so if you diversify away from the U.S. dollars, you want to be an export economy, it makes sense that China will continue buying and the central banks. And then we're in retail buying season now. It's Golden Week. It's going to be Chinese New Year.
Yeah.
You know, in India, they're buying. So we just see this continuing.
All that glitters is gold.
Exactly.
Nadia, thank you so much. Nadia Martin Wiggen, Svelland Capital Director. And coming up, Dubai's real estate market continues to attract strong investor interest, but is it at risk of a bubble? We'll discuss the latest report from UBS on global bubble risks next. This is Bloomberg. Bloomberg has learned that African Export-Import Bank is pursuing arbitration against Zambia over a debt relief dispute. The move could set a precedent for other nations restructuring unaffordable loans. For more, Bloomberg's Ndiro Ganga joins us now from Kigali, Rwanda. Well, really big story here, and this has been an ongoing restructuring ordeal with Zambia and some of their major creditors. What can we expect from this arbitration process?
Good morning, Jumana. So the outcome of this arbitration process at this point is uncertain, but what we know for sure is that Afreximbank has maintained that they are, or rather they have preferred creditor status. And as a result, just like the IMF and the World Bank, they cannot restructure their debt or they cannot offer any form of debt relief. And so in going into this arbitration, they believe that they're enforcing their legal rights. And so much is at stake here beyond the $50 million that Zambia owes Afreximbank. If Afreximbank ends up winning this case against Zambia, then it raises serious questions about Zambia, particularly from their bondholders and also the official creditors committee, because then it will mean that they will have to invoke comparability of debt treatment, and it means that the same favorable terms that have been extended to Afreximbank have to be extended to other creditors, and that could jeopardize this whole restructuring process that has taken nearly 5 years and is 90% complete. On the other hand, if Afreximbank loses, then it will be a slippery slope from there, because you have Ghana that has a significantly larger debt than Zambia of $770 million that will be next in line saying we also want to restructure our debt moving forward. And this could also jeopardize the credit rating for Afreximbank. We have credit rating agencies like Fitch that have raised questions about their preferred creditor status. And so if they are forced to provide debt relief, we could see them being downgraded from investment grade to junk status. And that could jeopardize their access to finance and also make it very expensive on the African continent. And while questions are being raised about why this has taken so long, it's less about Zambia and more about OCC, who say that they empathize and sympathize with the position that Afreximbank finds itself in, but it overstepped its mandate and went from providing short-term financing. And when that line was breached, what's good for the goose is good for the gander.
Well, I mean, that's a good expression, but at the same time, you know, they're targeting, restructuring. They've been, engaged now in this arbitration process with the creditor, but at the same time, also trying to rein in budget spending. They're targeting a budget shortfall of 2.1% this year. How feasible is it that they're going to be able to actually cut the deficit to this very low level, and possibly the lowest level in over a decade?
Yeah, I mean, hitting 2.1% is extremely ambitious. Will they hit it? Likely not. But will they bring it significantly low? Yes, they will. We've seen them do this before. In the last 3 years, they've significantly brought their budget deficit lower because of fiscal consolidation measures. And despite it being an election year, this is a country that sought to extend their program with the IMF by an extra year. They're looking to unlock $145 million. And we know that IMF money does not come short of conditionality. So IMF is going to ensure that their checks and balances, the country intends to spend about $10.4 billion. But because they'll be under an IMF program, they'll be watched very, very closely. The government will also be looking to raise revenue in forms of taxes. So where they're heading, despite it being an election year, the IMF is there to keep an eye and ensure that they keep their spending within checks.
Bloomberg's Ndira Ganga in Kigali, Rwanda. Thank you so much. Now, more news ahead coming here on Horizons Middle East and Africa. Stay with us. This is Bloomberg. Dubai's real estate market is showing an elevated risk of hitting a bubble. That's according to UBS. The bank's latest global bubble real estate index saw Dubai record the strongest risk increase from last year, together with Madrid. Joining us now is economist Matthias Holzhey. He was the lead author of the study at UBS Global Wealth Management's Chief Investment Officer. Good to have you with us. I'm just going to start off with a very simple question. How do you define a bubble? Does it just mean not sustainable, unsustainably high prices?
Well, good morning, and thanks for having me. With our analysis, we try to basically quantify, let's say, the risk of a housing bubble. And a bubble, as we see it, is basically just a mispricing of an asset. In terms of housing market, that means that house prices are sort of decoupled, let's say, from their fundamental value. So if you are, let's say, at high bubble risk, then we would say there is a lot of downside potential, and investors should not expect inflation-adjusted capital gains in the longer term.
Yeah. Okay, so let's go back to your report then. Miami shows the highest bubble risk amongst the cities in your study. High bubble risk also appears in Tokyo and Zurich, but Dubai has shown the highest risk increase. On what basis?
Well, Dubai has been a very special market in our selection. We run this analysis for more than 20 cities globally. We use always the same method. It's always a top-down approach. Maybe that's also something which I need to mention. Now, Dubai has, the market has broken all kind of records in the past 5 years. Okay, you recorded, I think the strongest price growth for the last 5 years, strongest rental growth in the past 5 years, strongest income growth in the past 5 years. And so that's all, and that's also the reason why you're not at high bubble risk at the moment. But lately, home prices have started to outpace rents. We now record the 3rd year in a row with double-digit price growth, and this is typically a breeding ground for speculation. So more and more investors are buying property for speculation purposes. Then we also see now a pickup in leverage. It's still low, but it is increasing again, I would say. And then we also have construction. Okay, we see the building permit are now reaching new highs, and also the size of the construction industry in Dubai, okay, is basically expanding compared to the rest of the economy, and that's also historically always been a risk sign. And maybe the last point to make is affordability. Okay, one more thing. And Dubai records the highest rent-to-income ratio of all cities in the study.
Okay, so last week, the Saudi Arabian Crown Prince Mohammed bin Salman announced measures to freeze rents in Riyadh for the next 5 years. What do you make of that announcement? And do you think that authorities in Dubai could consider something similar if rents and all of these other metrics keep rising?
No, you do not. That's the way to disaster. Basically, if you start to manipulate rents directly. What you can do if you want to manage the market, I think then you should maybe have a look at. There are many examples in our city sample. One, if you want to manage it tightly, you should do as Singapore does. You should start taxing. basically speculation. You should start increase, maybe it can be lump sum taxes, it can be vacant home taxes, it can be taxes on Airbnb. There are all kind of sort of measures which have a limited impact, but still may slow down a bit, slow down rental growth. But I mean, especially in the case of Dubai, I mean, it's strategy. Okay, it's the strategy is to grow, and that's also driving up rents. I mean, I mean, at some point you have to ask what you want.
Okay, just a final quick question for you to bring it back to Dubai. The price per square foot is still of value compared to other major metropolitan cities around the world. Is that one of the metrics that you're looking at to determine whether actual real estate is overheating?
No, that's not something we care about, because the absolute price level is given by supply, by building costs, by land value in the end. So that's not that important. But it's one reason why we think that risk reward in Dubai is still okay. I mean, just because it has an increase in bubble risk, the bubble risk itself is not yet where we had other cities in the past. So if you look at very high yields, and you have a price level which is still rather moderate compared to New York. I mean, half as high or a third as high. So that makes it still look attractive for many.
Matthias. Yeah, I'm going to have to end it there. Matthias Holzhey, economist at UBS Global Wealth Management's Chief Investment Officer. And that wraps up this edition of Horizons Middle East and Africa. I'm Joanna Bersecci in Dubai, but in London tomorrow. Stay with us for Daybreak Europe.